everybody's looking at these news events.
Uh-huh.
Last year, if you recall, January through April, it was tariffs. Okay. That determines the world. Okay. Trump came up with that and it spooked the markets. Everybody sold the news. Okay.
Hmm.
And then in April, he said, "Oh, I'll put a 90-day hold on it." And then market exploded back up again. And then suddenly tariffs have sort of lost their driving force. And where's the
Hmm.
S&P? Nowhere. I mean, it came, it went, the tariff issue. Now suddenly we have the Iran issue. Well, I have my own views about how that's going to turn out, and it's different than 99% of what most people think. But I think it'll be positive in the sense that the regime will collapse, but it won't be due to us. It'll be due to the in the street guerrilla warfare, etc. But anyway, which will surprise a lot of people. I don't think
Hmm.
it should be a surprise. So I think that situation's sort of over with,
Hmm.
even though it's not yet, but I think it will be. But again, it's a news story that dominates. And so what
Yep.
happened? You're supposed to buy gold on war news, right? That silly nonsense. There's so many premises out there that are full of malarkey, and that's one of them. So as soon as the war started, gold sold off. Okay,
Yeah.
it's over. Uh, and but actually, when you stand back and just look at the technicals, blank yourself out to the
Uh-huh.
news. Okay.
Uh-huh.
We look at the technicals of the US government debt market, T-bonds particularly, T-bond futures, 30-year bonds. They look like hell, okay? They've been
Hmm.
looking like bad stuff for a long time. That
Hmm.
is too big of a market to be bad. If it's bad, it's a nuclear event for the government, okay? And they can ignore it and not talk about it. But that market has been slipping and slipping and slipping ever since November when the Fed said, "Oh, we start buying bonds to provide liquidity,"
Yeah. Yeah.
quote unquote.
Yeah.
Well, T-bond prices have continued to ooze, challenging multi-year lows, and yields are back pressing at all-time highs on the long end of the debt market. Uh, and we have a Japanese bond market crisis. We have one
Right.
here. It's not a headline yet, but we have one too.
Hmm.
Okay. Couple that with what we saw in the financial sector several months ago, 4 and 5 months ago. We started identifying technical breakages that were
Hmm.
going on in the financial sector. Credit card companies, MasterCard and Visa, for example. I'm talking technicals now, not some headline.
Right.
And some of the major banks, not regional, major banks, big name banks, breaking momentum trend structures
Uh-huh.
that implied negatives ahead. No, it didn't imply crash. It just said, uh-oh, this guy's losing trend. And this is what happened in 2007. Back then, if you examined the financial sector, the S&P was making a new high when the
Hmm.
Fed did an emergency rate cut in September 2007. Went up for another several weeks, S&P did, but the financials had already slipped. They didn't go to a new high.
Hmm.
They'd already broken our long-term momentum trend structure. And of course, the reason was out there. The mortgage crisis was pending and
Right.
denied by the Fed and so forth. But right now, it's even bigger than that. It's not little private mortgages. It's now the credit card industry, bank loans, and the U.S. government bond market is in jeopardy.
Yeah.
That's like, that's too big to ignore. Okay. And
Right.
though the Fed never talks about it, it's not one of their quote mandates. It's their mandate. And right now, the stuff's hitting the fan, but not only in the private credit market, which is finally being acknowledged by the financial sector, the financial TV shows, and the government bond market. So we suspect there's another news event about to happen out there, and that is the Fed suddenly cuts. Not at a regular meeting, but surprise rate cuts. And I wouldn't be shocked if there's several real quick. Something people don't expect. Now, the stock guys will think what? Oh boy, it's party time again.
Yeah. That's what they'll
Okay, they're going
say.
to print the money. We're going to
Yeah.
print more money. Oh
Yeah.
boy. Okay. Yeah, it might work for a little bit of a rally, but we've been arguing since January last year, before that break occurred, that we're in a quote topping process.
Hmm.
And if you go back and look at the tops in 7 and 8, 2007 and 8, it spanned a whole year. Look at the 2000 top, it spanned a whole year. Well, this one's been going on for a little bit over a year right now. And where are we right now in price? Well, the S&P right now is trading about 3 or 4% above the price high. No, about 5% above the price high of last year.
Hmm.
So it's been a sort of a waste of time, you know. Meanwhile, monetary metals have exploded. Anyway, those are
Yeah,
factors that you need to be watching, not these silly headline stories,
right.
because these are underlying macro fundamental technicals that ultimately will drive the central bank berserk.
They're telling you to watch tariffs, wars, and headlines. But what if all of that is just noise distracting you from something much bigger breaking right now? According to Michael Oliver, while everyone is focused on Iran and market headlines, the real crisis is quietly unfolding underneath the surface, and it's far more dangerous. He points out that the US bond market is already slipping toward multi-year lows, with long-term yields pushing back toward all-time highs, something that should never happen in a stable system. At the same time, we're seeing early breakdowns in major banks, credit card giants like Visa and MasterCard, and the broader financial sector, mirroring the exact technical patterns that showed up before the 2007 crash. But this time, it's not just housing, it's the entire credit system and a $10+ trillion government debt market under pressure. And here's where it gets critical. Oliver warns this could force the Federal Reserve into emergency rate cuts, unexpected, outside scheduled meetings, potentially multiple times in rapid succession. Now, on the surface, that might look bullish. Markets could rally briefly. But historically, that's exactly what happens right before major breakdowns during what he calls a prolonged topping process that's already been playing out for over a year. Meanwhile, while stocks are barely 3 to 5% above last year's highs, the underlying system is deteriorating fast. So the real question is, if the headlines don't matter and the bond market is signaling stress this big, what happens when the next surprise event hits and the Fed is forced to react?
Right. Well, so you really believe that the underlying breakage now in the bond market, in the treasury market, is much worse than 2008, 2009
Yeah, they've been.
because of those factors. There's so many
Yeah,
underlying.
yeah, yeah. It's finally come to pay its dues. Okay,
Yeah,
you know, Jamie Dimon said this a year or two ago that you can't keep playing this government debt game that expands,
right,
and you ultimately have to face reality.
right.
Okay, well, they haven't,
No,
and reality's there, just like in the Japanese bond market, where they're well, the new prime minister said we're going to print, print, print.
yeah,
Okay, so what does that mean? Well, Weimar Republic or something like that.
yeah. You would think
Whatever.
so, and
Yeah,
they're not trying to cap the interest rates, though, are they? They're
no, it's yeah,
realizing they
yeah, yeah,
can't.
yeah. No, it's a real problem for them, but it's not just Japan. We all know that the European bond markets aren't in good shape, UK, ours. So it's not just, oh, an isolated event. And even if it were, Japan's too big to ignore. Okay.
Yeah,
It's not
yeah,
some third world country.
yeah.
And we've got the same problem. It's just masked over a little bit better. And gold knows that. Gold is nothing but the inverse of decaying money units.
Hmm.
Okay, they print, 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 gold goes up, up, up. It
Yeah,
maintains its value versus
yep.
uh, the so-called money. Okay,
Hmm.
um, and it's not just what the dollar is, or it's a combination, of all the major currencies in the world. Well, we're headed for that crisis. Gold knew it a long time ago. It's now powered into a more accelerated phase. And yes, we just had a nasty stumble.
Yeah,
It's got to be the top, right?
yeah.
Okay, well, yeah. No. Our technicals say no. Look for a buying point if you're not in. MSA put out three major long-term based buy signals starting in March of 24,
Hmm.
June of 25, and the November close of last year
Hmm.
for both gold and silver. We're not going to offer any more primary entry points. If you're
Hmm.
not in, you're chasing. That's fine if
Yeah.
you want to participate. But got to remember that when you buy well after those buy points, and that average for silver, for example, those three buy points was
Yeah.
30. Our average price was $36.
Yeah.
Okay. Yeah, you've given back some profits, but where do you sit?
Hmm.
Yeah, right now, even double. Okay. Uh, we think by technical assessment that this pullback that we had at the end of January, and if you look at your daily charts, it was like a 1 day crash, followed by follow-through on the first day of February. You could draw a line sideways on silver and gold through that price level.
Mm-hmm.
Most of the action since then has been above it.
Mm-hmm.
We got below it this week. Why? Okay, think about this. For 15 months in a row, and even more months on a closing basis and a high basis,
Mm-hmm.
gold has continued to make higher highs.
Mm.
Higher price highs
8
during
months in a
higher
row.
closes. Finally, February produced a down monthly close in
Uh-huh.
gold, okay, and produced a lower price high. The one thing we haven't done, and we noted this in our weekend report, when gold was still above the February low then, we said, hey, if we'll just drop and take out 44.23, it was the February low, gold will finally, after 15 straight months of higher lows, made a lower low.
Uh-huh.
And it did. And right now we're back up to that low 4400s.
Yeah.
We think that on a short-term basis, signals that say we're going back up again are literally about 2.5% above where gold is right now. You get back up there, especially on a weekly close, like in the lower to mid 4500s, and assume, okay, that was it.
Uh-huh.
So if you're not long and you're a chaser, well, at least view this as an opportunity to enter after a good break.
So when you step back and connect all the dots, this isn't about tariffs, wars, or whatever headline is trending this week. Those are distractions. What Michael Oliver is pointing to is something much bigger and much more dangerous. The bond market is breaking while the yields push toward historic highs. The financial sector is quietly losing momentum, just like before 2007. And now the entire credit system, from banks to credit cards to a $10+ trillion government debt market, is under pressure at the same time. And if that wasn't enough, this all points toward a scenario where the Fed may be forced into unexpected emergency rate cuts, not because things are strong, but because something is starting to break behind the scenes. At the same time, gold and silver aren't reacting to headlines. They're reacting to the slow collapse of confidence in the system itself. And according to Oliver, this recent pullback isn't the end. It could be the setup for the next major move higher. So the real question isn't what the headlines say next, it's whether you're paying attention to what the system is signaling right now.